Hello, everybody. This is Noah and John, and we are from UrbanDigs. And today we're talking Manhattan. And Johnny, I got Ben Dixon here of
Yep.
the Mackay Dixon team over at Elliman. These guys, these guys are like a production machine, and we figured let's get some producing guys over here to tell us what the hell's going on in the markets.
It sounds like a plan.
Yeah. So Ben, thanks for joining us.
Thanks for having me. I'm excited to be here.
Yeah, we're excited to have you. So, listen, let's start high level. A lot of things are going on, and let's tell everyone what is going on in the Manhattan markets today.
Sure. It's a really exciting market right now. There's a lot going on. But first, let's talk about how we got here. Obviously, we're in a really interesting part of the cycle.
Mhm.
And I'm going to step back. I'm not going to go back all the way. But, go back about 10 years and quickly run through. We really saw some strong price appreciation a couple of years after the financial crisis, 2 to 3 years. And then the last time we really saw that bull run was 2012, really in the 13, 14, and 15. If you remember 13 and 15, people were running to see apartments, cash in hand, multiple bids. That was the last time New York really felt on fire.
No inventory back then.
No inventory, we were down around 6,000. And we were seeing it was on fire, really. We were going 80 miles an hour in a 55. And then in 2017, 16 and 17, maybe we were going 50, but it felt like we were going backwards almost. We saw a little price appreciation, but not a whole lot. Go into 18 and 19, and we saw prices come down. We had a lot of inventory, a clear buyer's market, and it really felt different for a lot of sellers who had purchased back in 13 and 15. Come into the beginning of, and even in early 19, we had these 2 weeks of activity where we thought we were turning the corner, but we didn't. Roll into 2020, strangest year in real estate we've ever had. And we started off with 10 weeks of great activity. We did turn that corner. We felt it. It was sustained. It felt good. We had multiple bids happening again. And come along to March 13th, and the rug's pulled out from under the market. Agents can be fined, we can lose our licenses for showing. So the market went on hold. We actually had 13 deals in contract on March 13th. I think my biggest accomplishment last year was closing every single one of those deals.
Wow.
A few extra gray hairs, but we got it done. And then we really expected to see a big pop in July and August when we had pent-up demand. Since we couldn't show for a few months, we didn't see that. Nothing happened over the summer. It was pretty slow and sad. Then we thought maybe it's going to be the fall market. The fall market's typically our secondary market. It's going to come back. Again, no. People who had gone away for the summer extended their summers. And I think we had a lot of election distraction. A lot was going on in the world. And we really saw things starting to pick up around Thanksgiving. Once election results were known, people felt confident they were going to stick. Then we saw things happening. We saw a real uptick in December, which usually says that means we're going to have a really busy spring. And that's exactly what we're having now.
Right.
Things really started picking up in January, and we've been off to the races ever since.
So I'm glad you kind of did a whole little recapture, because John and I always talk about the fact, buyers expected that this COVID thing that we're going to be 25, 35, 40% deals, and there wasn't. And we were trying to explain, guys, we've already kind of went down. And you just, thank you for just reiterating that for anyone that doesn't know. 2015, 16, we kind of started going downwards, and we went down, and we were coming out of it. We were coming out of a 4-year downturn right when COVID hit. So I appreciate that. So when you look at deals happening right now, okay, right now, and where we're going right now, is the activity, are we off the charts? Are you seeing bidding wars? Are you having trouble putting deals together? What's happening?
Yeah, we're seeing both, and it really depends on price point, on neighborhood, how prime a building is. We're not New York's a city of extremes, right? Everybody thinks, is it a buyer's market or is it a seller's market? Right now, we're in a transitioning market, and we don't know where we're going to end up just yet. We have some views on that, which we can talk about, but we don't know exactly where we're going to end up. Right now, it's not a low inventory, high demand, tons of multiple bids.
Mm-hmm.
And it's not a lot of inventory and no demand where it's a clear buyer's market. We're clearly transitioning out of that. But right now, we are hovering around 10,000. That's a lot of inventory for Manhattan. But we had over 5,000 contracts signed this year to date, 700 in luxury. That's more than we had all last year combined. So where that demand will outpace the inventory, that's what we're going to have to watch and see. But that is where we're transitioning to right now, is a really healthy market.
That's interesting. And so let me ask you then, because I think you hit the nail on the head, which is, one of the things that makes today's market a little bit unusual is that there is a lot of supply and there is a lot of demand at the same time. And if you had to take a crystal ball and just sort of shift it forward, I don't want to jump too far ahead here, but what does negotiability look like right now on the buy side? And how is that going to play out when this eventual bull run of record-setting deal amounts per month starts to dwindle off?
Yeah. So let's look at new development and resale separately, two really different markets right now. And we're looking at new development in the luxury side. In the last couple of months, last 2 months, I would say, we got over 35% off on one deal. That was a 10-digit deal. That's a big luxury deal, but over 35% off is a big hit for a developer to take on a trophy penthouse. Another building closer to the 10 million mark, we got 20% off for our buyer. So we're seeing a lot more negotiability in the higher end new development, right? That like high 2000s, mid 3000s per square foot. That new development has some big negotiability, especially on their bigger units. If they're looking at one sale that could be 5 sales of their average unit, they want to get that unit moved and get some wins on the table, on the board. We've also seen some that have 5%. Another developer will have a different strategy. They're not holding those prices that they were expecting to get from the 2013 to 15 trajectory. They've adjusted their pricing from Schedule A. They're getting more people in the door. And those, $2 to $3 million apartments that are priced well, under 2,000 per square foot, might only be getting 5%. Maybe nothing on the price, just some concessions. So a really broad range of negotiability on new development, but I would say more negotiability in new development in general than resale.
Well, are there any buildings in particular that might be more negotiable than others? Could you share?
Yeah, I would say I've got, if I look around town, I've got a handful of really kind of the favorite new developments right now, or that when I take buyers into, they're really reacting to well. 53 West 53rd, that is, Midtown, having some troubles, not as many people in the office, but I think we all probably believe they will be back. And that building is, ranges anywhere from 3 million to 65 million. So a price point for just about everybody. And your price per square foot there is, at the higher end, around the $3,400 a square foot. So I think if you've got high-end buyers who like that, excuse me, that hotel finish, hotel service, that's a great product to be bringing them into, where they can get a great deal. We also have Gramercy Square over on the east side. It's a big project. They've been marketing it for a bit, and those are typically larger homes with bigger prices on them. So I think you can get some additional negotiability there. Really amazing amenity package that always wows my buyers. Another favorite up on the Upper East Side is Beckford House and Towers. Those are in the upper 2000s, larger homes again, which people are searching for right now. They give you that like pre-war feel and that kind of Upper East Side history, but just really beautiful. Not as much negotiability there, I would say, just because it's a unique product on the Upper East Side that's being received really well.
Right.
And I really like 130 William and Lantern House. I think you'll see very little negotiability at 130 William unless you're going up into their kind of trophy penthouses at the top. But they've really reacted to the market with their pricing. The pricing is really nice for a great product.
Let me ask you, Ben, if I could. We've talked about this before on the podcast, and that's that negotiations and new development is really difficult. And I'm just curious if you could sort of walk some of the agents who are new to the new development market through how you can kind of achieve some of these negotiations. Are they on the amenity side, whether it's getting free storage, that kind of thing, or is it on the Schedule A side where you're actually talking about a reduction of price? And if so, how on earth did you manage to do that?
Yeah, do your homework. Like, you have to really do your homework. You have to go into the city records if the developer is not recording their sales. If there have been sales in the building, you can really build a case for where things are landing. if you can't do it in that building, got to pick the building that's most similar to it and do it there. So you got to do your homework. And I think really focus your buyer on where they're going to land on a net basis, right? Buyer's going to care about cash out of pocket, their ultimate number. The developer might care about different things. They might be looking at bottom line. They might be looking at where their sale price lands for their other comps in the building. So I would typically go in asking for the kitchen sink. Every concession, the free storage, free parking if it's there, free common charges for a year or two, like throw in the kitchen sink and see where they come back. Some developers are really concerned about their price and they're not going to negotiate on it, but you might get a design credit for that amount that you were looking for on the discount. So I usually try to let the developer lead as to where they're going to give me the discount, but make sure my buyer has a view before we go in as to where we want to land at or below.
That's great, because I mean, there's so much stuff right there in what you just said. I hope agents just listen to that a couple of times, because I mean, we've had Shlomi Ravini on here. I love Shlomi. He tells it like it is. And he always said, guys, like when you're dealing with developers, first off, you can get 5 or 10% here, and you can get 20 or 25% here. It all depends on all these different things that you confirmed. And Shlomi said, pick up the phone and talk to the developer. Like get on the phone, talk to the sponsor, talk to the sales guy, whoever's leading, find out where you're at and pass that information on to your client. I mean, they all want to do deals, in case you're worrying about insulting anyone. Even if you call them up to say, listen, I got a buyer that's going to throw a kitchen sink offer at you, say that and let them know up front so they know what's going on. And then we're brokers, right? We got to broker a deal here. So,
that sales team the sales team can be a real ally. Obviously, they represent the developer. They've got a job to do, but they want to get deals done with you.
Yeah, exactly. Use the weapon. What about resales? What's happening right now with deals and resales?
Yeah, resales are really fun because they're all over the place right now. I recently lost 2 bidding wars on the Upper West Side. These apartments were like $2 to $3 million. My buyers followed my advice. They wanted the apartments, but they weren't going to die without them, right? So we went at market, tossed in a little bit on top of that to try to get ahead of anybody else doing their comps. And somebody stepped in, 2 different buyers stepped in on both of those and just went way over. These were people that probably had missed out on 1 or 2 or 3 other bids and just weren't going to miss out again. And we're taking a long-term view. So there's always, that potential that somebody's going to come in and just overpay. Your buyers don't want to do that. They're not going to win. So that's happening on the uppers. I feel like the Upper West and Upper East are having this renaissance at the moment. They were the first to really start to come down when prices came down, and they're having this renaissance now and coming up. So I'm seeing that happen on the Upper West Side. And I'm seeing other things sit on the market for a really long time. If you're trying to go back to a 2017 price right now, good luck to you. That's going to sit on there and be on there for a while. Right now, for my buyers, I'm loving finding stuff that was slightly overpriced or came on in January or February. It's looking stale right now. The seller's having a really different experience than those sellers I just mentioned that were getting multiple bids the first week. And let's try to reach back into that January market and get that discount. That's a lot harder to do when somebody comes on priced right today. We put a listing on last week at 540 West 28th Street, priced it right at market at 1450. Within a week, we had 2 offers and we're over ask. So pricing it right now can get that type of momentum. There's enough demand to go at or just under and expect the market to lift it up.
It's a fantastic point. And so let me ask you this, because I think you brought up something really interesting, which is that you're being punished. Like sellers today are being punished. If they've been on the market for too long, you're being punished. And it's just, there's nothing you can do about it because you look stale. And I'm curious, what sort of listing discount are they looking at? I mean, had they priced it right in the beginning, we're looking at, maybe 5% or less because that's where the market is. But like right now, if you're a stale seller, are you looking at market or are you now looking below market? And if so, like how much should buyers lowball them? I think is the question.
Right. Yeah, I think you're looking somewhere between 5 and 10% on what you lost, hopefully closer to the 5 for those sellers. I mean, our average discount to list is around 5. We're seeing some things going over, so you're kind of more than 5% on those. And I also think that's just a lot of buyers and brokers start off with a 10% off the ask. You end up close to the middle and end up at 5. So unless you grossly went over and are really been on for a while, it's probably between that 5 and 10 with closer to 5. Because the new demand is looking at the new stuff. So on a demand note, we're listing a 4,000 square foot loft at 30 Crosby later today. That'll be 8,750,000. I had 5 emails that I was able to send to brokers who were sending out their in search ofs over the past few weeks that I knew were going to match that. So we've got people who have exhausted the market. They're sending out emails to the brokerage community saying, I'm in search of X, Y, and Z. I was able to capture 5 of those just in the last 3 weeks and respond to those agents before this comes on the market. So that type of demand, we haven't been seeing that for a while, unless it was something really specific.
So, go ahead, Noah.
I was just gonna say buyers exhaust that pool very quickly. I just want to reiterate that point. They sellers need to understand, if you're on the market for 3 months, 4 months, 5 months, you're chasing it. You mispriced, you messed up. Own up to it. You should have cut your price in week 2 or 3 is what you should have done, because buyers are real. They're not looking at those price cuts because now you just lower your price. They'll just wait. They're looking at all that new stuff that's coming on. You know,
and I will say, like, we talk about negotiability and what percent off are we going to get off the list. I tell my buyers and sellers the same thing. Listing prices are just part of your marketing. Yeah. And it really doesn't matter if you got 20% off, great. But if you paid 10% more than the guy next door for the same thing, that doesn't really feel like a win for me. So really it's about relative value and like, what am I paying versus what somebody else paid, not what am I paying versus what maybe an experienced or inexperienced agent or a greedy seller listed their apartment at.
That's right. That's a fantastic point. And let me just bring it back on the demand side, because who is the demand side right now? When you talk about answering all these, who are these buyers that are in search of these properties that they can't find? Is there a constant thread that's running through these folks these days?
Yeah, I would say we have a couple. So we are working with a lot of first-time home buyers that either got priced out of the market during the last 10 years or are now seeing it as the moment for them to jump into the market. We're looking with families that are upgrading. So, or even couples, actually. I just did something, a 3-bedroom for a couple with no kids, no plan for a bigger family. They wanted a bedroom and they each wanted their own home office because they're at home now. Like, how we're using our homes has really changed. We're not just sleeping, showering, and heading back out the door. We're in our homes a lot more. So we're seeing people who need more space, which I think everybody's talked about that a lot the last few months. We're seeing people who know this is the moment if they're ever going to jump into this market to get into it. And, you know, right now our foreign buyer is a suburban buyer coming back into the city. They're coming from Westchester or New Jersey. They're not, yet coming from China or Russia. They're coming from pretty close by. And these are people who, in my experience right now, have like a couple of kids. The kids are going to be out soon, but are still at home, and they're planning for a really great pied-a-terre in the city because they want to have some fun. It's this new interesting buyer who's been out there, has some money now, coming back and buying a fun pied-a-terre in the city that they'll use with the family, but probably really are planning for it once the kids are off to college.
Yeah. That was a great question.
Keeps coming up. It keeps coming up for me, that buyer, which is not a buyer we had a few years ago.
Yeah, we're not operating at full capacity, are we, Ben? Like,
No.
In terms of foreign buyers, investors, all those different types of buyers that usually look at our product, like they're just not at full capacity right now. So like, we're doing all this at half capacity or wherever we are, just not, with a buyer pool.
Yeah, I think it's going to be really exciting once the travel restrictions really open and we see those people coming back in. We see, Latin America coming back up. I think there are going to be some real interesting waves after the local foreign buyers and the local buyers have bought, and then we see this new wave come in.
And that's the long runway. That's the long run. I mean, and also the urban did not do what the suburban did. So from a value perspective, the suburban's bubblicious, the urban's not. That's all the whole long runway argument. Go ahead, John.
Well, I was going to say, if you don't mind, Ben, I'd like to talk to you about that suburban environment, because, that's one of the things that Jonathan Miller was talking about early on, is that the idea that now people have sort of the dual primaries, they've got their home in the city and their home in Westchester. And I know you guys do a lot of work in the Hamptons. I'm just curious, like, what that market's looking like, because we know it's been going bonkers for the last year. And I'm curious, is it still crazy, or is the idea that maybe travel this summer is opening up, is that taking some of the heat out of that fire?
No, is the short
Yeah.
answer. It was really last year a tale of two cities. People were clearly moving from one place to the other place. Pre-2020, the Hamptons also was feeling more like Manhattan. Kind of, they were trading in the same direction. Prices were slow, things were sitting on the market. Was not a very exciting place to be selling in. And then in April of last year, the rentals started. I've never done more rentals in the Hamptons in my life. We did a $500,000 rental for somebody in under 48 hours before they even saw, they came out. I held my breath the day they came out to actually move into the house to hope that they liked it. So that was frenetic. It was wild. It was crazy. April through the summer out there. I mean, the stats are all off the charts, 3 times the volume, things like that. I would say rentals are up 25 to 30% on price easily. They're the same this year. There's no change to that. There's a little less people freaking out about getting it and like calling you scared. Everybody kind of just knows that those are the new prices this year. So a little less price discovery, more like we just know that there's tight inventory. And then on the sales, 2020 saw huge volume. Anybody that was sitting on the sidelines wondering when they might sell came into the market. And now it's more like it was in Manhattan 2013, 2015, very low inventory unless you go to the real top of the market, like anything around $1, $2, $3, $4 million. That the day it comes out, it's going to be a swarm of brokers at the open house trying to find parking to get in. And then it's going to be a swarm of buyers coming in over the next few days. If it's not priced egregiously, it's going to have at least a couple of offers happening in the first 7 to 10 days. Like it's moving. So
I feel like this is everywhere, like national. I'm hearing stories like this all over the country. I mean, you got lumber prices going through the roof, copper prices, everything, steel. I mean, it's frothy is not even a word to describe where we are right now. So, I mean, it's fun while we're at it. I don't know. I got to think this rolls over at some point outside Manhattan, but I want to go back to Manhattan because we're getting to the end here. So let's focus on Manhattan for a second. Is there a COVID discount anymore?
I would say because we have so much inventory, we can still get a COVID discount if a buyer's willing to buy something with a little hair on it. So somebody priced too high, they have high monthlies, maybe the light's not so great, it needs a renovation, view's not great. Anything that is kind of towards the bottom because we have so much inventory can still grab that COVID discount. You're not getting it on a 3-bedroom, $3 million in Chelsea with nice light and in a decent building, right? So like the cream is rising to the top. That's what's getting the multiple bids. That's what's selling very quickly. The stuff that's staged, looks nice, has been painted, no issues with it. So can you get a COVID discount? Yes. And I actually think that's a great buy thesis right now. Somebody who's buying into the market is buy something that has that discount. We will be in a different part of the cycle in a year, 2 or 3, or whenever it comes. And at that point, buyers think, I'm buying in Manhattan. Of course, I have to make a compromise, Right. So the compromise discount will shrink at some point in the market cycle. So if you have buyers looking for value, the stuff that may not be at the top of their list might be their best place to buy. Grab that value, either fix the issue by renovating, putting good lighting in. Obviously, we're not going to change location, but there are things you can do to minimize those issues, I think, and really create value for a buyer that's focused on that.
Good stuff. Ben, this is great. I think we're towards the end. John, do you have any final questions for Ben?
No, if I could just follow up on that value conversation, because that's near and dear to my heart. I love talking about that stuff. And I'm just curious, Ben, I'm not sure if you have any investor clients, and investors are always looking for value, especially when they're looking for one-offs, like a condominium that they can rent out. Maybe they'll turn into a pied-à-terre in 10, 15 years. But when you're looking for that, are there any, you mentioned some of the new developments earlier. I'm just curious if there are any particular neighborhoods, folks should go to if they're looking for more value-oriented plays.
Yeah, I would say right now for value, we actually have a lot of like families buying for their kids right now, knowing that the kids are going to not use that for too long. So they'll buy for the kid for the next couple of years and then assume it'll be a rental property after that, right? Rents are at the bottom right now. So go in and get a good deal on the buy, put your kid in there for a couple of years while they finish school or get their feet under them, and then turn it into a rental property after rents come back. I like that play right now. As far as location, Hudson Square, West Soho, like a lot going on there with Google and Disney, and a lot going on there with construction right now, and some nice new developments. Greenwich West is beautiful. We just did a deal at 77 Charlton. Like there's some nice buildings over there. So I like that area over there. You're nicely sandwiched between that upper Tribeca and the West Village. So I see that as really going up in the future. And then I'd be buying like just around the edges, like Nomad, Lower Murray Hill, even, you know, some of these spots up around Hudson Yards, which has had kind of a fits and starts, but have some really nice loft buildings over there that are cool. And when we look for our investors, quite frankly, we look at everything that might fit for them and we sort it by monthlies. Low monthlies are often the key to getting them a really great return. There's no use in looking at something with a high monthly, it just never plays out. So we look at neighborhood, we look at kind of their budget, and then we usually sort that list by low to high, and that's what we start to go look at.
I love it. Great stuff.
There's some gold here, Ben. Thank you very much.
Yeah, there's a lot of gold there, a lot of nuggets. Ben Dixon, thank you very much of the Mackay Dixon team over at Elliman. That is John Walkup. I am Noah Rosenblatt. We are both from UrbanDigs. This has been Talking Manhattan, and we'll catch you next time.
Thanks, guys.